What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey. Software has become one of the most intensely debated areas of the market. The group has fallen roughly 25% from its September 2025 highs, but the underlying fundamentals have not deteriorated nearly as much as the stocks might suggest. That leaves investors wrestling with a much bigger question: is this simply a valuation reset, or is artificial intelligence beginning to undermine the traditional software business model? To help us separate the real risks from the market narratives, we're joined by our colleague Billy Fitzsimmons, Senior Research Analyst at Piper Sandler, who covers enterprise software. We discuss whether AI will reduce the number of software seats companies need, how vibe coding could change the competitive landscape, and why investors are increasingly valuing software companies after accounting for stock-based compensation. We also explain where Billy believes investors can still find opportunity, including hyperscalers, consumption-based businesses, and select vertical software companies. Later, we dig into the enormous capital spending behind the AI infrastructure build-out, the growing balance sheet debate surrounding Oracle, what Microsoft needs to demonstrate with Copilot, and why the eventual public listings of OpenAI and Anthropic could be a major clearing event for the entire software sector. Billy, thanks for joining us. Let's begin with the question you're hearing most often from clients. After a 25% correction, is it finally time to become more constructive on software?
Thank you so much for having me, Michael and Steven. It's great to be here. Launched at Piper at the start of this year, but have been covering enterprise software for about 10 years collectively, including most of the names in this list. 23 names right now that we cover. Maybe taking a big step back and talking about the headwinds for software where clients see issues. And to answer your question, I actually think most investors are continuing to shun the space in many ways. I think there have been a couple days where maybe that SMH is down a few points and the IGV is actually up. And we've had these fake outs a few different times in the last, call it 2 to 3 months. And when that happens, I will get the question, is now the time to get more constructive on software? What we're finding with clients is that people are picking their spots. They're sharpening their pencils on names where there's either an AI insulation argument, which there aren't many of, to be totally honest, in enterprise software, or where there's companies where they're viewed as direct AI beneficiaries. And those are names where it's actually showing up in the financials already, and you can get comfortable with the fact that rev growth will actually accelerate this year or next year because of AI. I think broadly, we talked about how the IGV was down 25% since September. Broadly, there's a handful of issues we laid out when we launched on this space in February. I think the big concern for the last, call it, few years was that when ChatGPT launched, is AI going to be so good that it actually reduces hiring needs? And seat growth has been a phenomenal tailwind to software companies for a number of years. And now the concern is it could be less of a tailwind or become an outright headwind if AI is so good that it allows companies to do more with less. And I bring that up because a lot of companies I cover, I'd call it the application software layer. Now, granted, I cover the hyperscalers, so Microsoft and Oracle play in that space. There are some names with different types of pricing models, but to use an example of Salesforce or ServiceNow, historically, they would charge per person per month. That was their pricing model. And then there'd be add-ons on top of that would allow you to grow ARPU, so that's average revenue per user, or ARPC, average revenue per customer. And so that was the standard pricing model for a lot of these SaaS applications. And I would separate apps that I cover from infrastructure, cybersecurity that Rob Owens here covers, where for a lot of Rob's names, the two of us aren't interacting with those tools day to day for the most part. Whereas a lot of my names, these are applications that I would access every single day to do my work. And Microsoft would be included in that. Think of Excel, Word, and PowerPoint. But the issue was, I think challenge number one is AI so good that it reduces seats. Just a side note on that, I think people probably, in retrospect, COVID was probably, people underestimated how much of a pull forward COVID was, because that was a kind of a phenomenal catalyst to modernize your IT environments when everyone was working from home. And that kind of catalyzed this broad shift from on-prem environments to the cloud. And so you saw certain industries like I'll call out communication software or payroll software where growth rates inflected significantly. And now on the other side of that, you've seen this huge decel in growth. I think the other headwind for software that a lot of clients are talking about, and this is the newer one compared to seats, would be, and you can extrapolate this in a number of different ways, but think about like vibe coding disruption. So the broader concern when GPT-5 launched in August 2025, they showed demos of, instead of just facing with a chat app and asking questions and using AI to be productive, it was you can ask AI models to basically build you. A lot of the demos showed basically like video games, but the implication was you could actually build software from scratch with that. And I think we're still relatively early in this playing out in kind of real time, and large enterprises actually call it vibe coding software, going to the frontier models and asking it to build something of complexity that you're using day to day. And to be clear, there's a lot of questions around the viability of that in terms of governance and scalability, and managing software for a lot of enterprises probably isn't their core competency, but it's evolving really quickly. And you've seen the improvements in 6 months, a year. And so then the question for investors is, well, what does vibe coding look like 1, 2, 3, 5 years from now? If it continues at this rate, you could live in a world where the concern or the ultimate bear case is where someone goes to the latest Anthropic or OpenAI model and creates a CRM system from scratch that's totally tailored for their organization. And that's maybe easier or cheaper for them than buying like prepackaged software from an existing vendor.
Yeah.
And that can be extrapolated in a number of ways, whether in terms of the bear cases, whether if the barriers to software engineering come down, maybe that leads to more competition. We hear a lot about AI native startups who are moving really quickly, or in some cases potentially have better products. And so that's created a big overhang for the space, and it's being hotly debated. And I think part of the issue for a lot of software names is when ChatGPT came out, painted this picture of, hey, our revenue growth will actually accelerate because of AI, because we can sell our own AI products and expand ARPU like we talked about, and we will actually grow faster. And what we laid out in our launch piece in February was that if you go back a year, if you went back to the start of 2025 and looked at consensus growth rates for software, consensus across 100 of the largest software names is actually modeling that rev growth would accelerate in 2026 from 2025. But that really didn't materialize. A year later, if you looked at it, it was a continued decel from 2021. So I think all these headwinds would be less of a concern if we still had sizable growth rates. We're seeing this acceleration that many of these companies promised, when in reality, growth rates continue to decel for most of the list. And I think that's the concern. That is AI disruption showing up in real time? Is there anything these companies can do to accelerate? And frankly, again, companies have promised kind of an AI-driven acceleration at the app layer, or more of a shift from seat-based, consumption-based pricing models. But that's taken a lot longer than I think investors originally thought.
That's great. So you cover a lot of companies, and there are a lot of different companies. We can dive deeper into the details, but just an aggregate, and given what you said, and given the 25% decline in the group since last September, has that been predominantly multiple compression, i.e. the fear of everything that you're talking about and rising uncertainty? How has the earnings trajectory changed? How have you changed your general numbers for the group, and how has consensus changed? Has any of this showed up in terms of either acceleration or potential destruction from all the fears of AI cannibalization?
Yeah, it's a great question. For the most part, it's been it has been multiple compression for the most part. And I think if you look across the group, if someone wasn't in the weeds on these names and talking to investors, and maybe was just looking at some of these, call it large cap horizontal names like a Salesforce or Adobe or Workday, the argument can be made that nothing in the numbers has really been, call it disastrous. Most of these companies are still growing at double-digit revenue growth rates, some of them a little smaller, and call it an organic basis. But these companies are still showing double-digit revenue growth and earnings growth. I think the concern for software for a long time was that SaaS models for a while during the go-go days were not profitable. And the bull case for software for a long time was if Salesforce, ServiceNow, Workday were signing multi-year agreements with large enterprise customers, there's high switching costs. And so we looked at something called LTV to CAC, so the lifetime value of kind of contract versus CAC, which is the cost of customer acquisition, and getting comfortable with, hey, if a business has a long LTV, long-term agreements, and low cost of customer acquisition, you could underwrite the fact that it's okay that they're unprofitable now, because at a certain point they'll scale enough so that earnings will, in margins, I should say, margins would inflect and earnings growth would improve. And for most of these mature names, we already have, call it 25 to 35% operating margins or free cash flow margins in many cases. So you can look across the group. We're actually still seeing good double-digit EPS growth. I think what's changed is, due to concerns around AI, the fear remains, what about a year from now? What about 2 years from now? What about 3 years from now? And that's led to the multiple compression. And I would just say as well, for years in software, we used to talk about, call it non-GAAP EPS, and you would back out stock-based comp. And I think this is important to understand where investors' heads are at. Year to date, we have talked more about, call it GAAP profitability for the group, which for a long time investors didn't anchor to, or EV to free cash flow minus SBC. And there's a variety of reasons for that. For a long time, software investors did not care or were willing to look past high stock-based compensation, because the view was, if you want the best engineers at your company, you need to pay them in stock. And everyone was happy when software stocks went up and to the right. But now in a more challenging environment, SBC is scrutinized because every day the stock goes down, you want to keep your employees happy. So you might need to make them whole on what they were promised. And that actually leads to potentially more dilution. And so just across the group, I think it's important to underscore, many investors in my conversations have taken the most conservative valuation framework possible, which is no longer GAAP price to earnings, non-GAAP price to earnings. It is GAAP, even free cash flow, ex SBC. And I think some of these companies are in a tough spot in the sense, if you're a San Francisco-based company and now your multiples in question and the stocks come down, now you need to dilute investors further and offer employees more shares to keep them happy. The challenge is that's where all the AI native companies are. And so your best engineers could theoretically go to OpenAI, Anthropic, an AI native company that could potentially pay them more in stock-based compensation. And so that puts some of these incumbent companies in a little bit of a tough spot from an SBC standpoint.
Sounds like you're saying earnings have remained relatively strong. There's definitely been the COVID pull forward that's slowed down the growth rates. That being said, how much credence do you put into some of these risks of seats and vibe coding coming down the pipeline 1, 2, 3 years out? I know the group has been hit a lot on it, but a lot of it's behavioral. People tend to be binary. It's going to be the apocalypse or it's nothing. And that would make sense with being reflected in the multiple. Getting out the crystal ball for a second, how much do you fear some of these anxieties that are being reflected in the space?
Yeah, it's a great question. I would say when we launched an assumed coverage on Feb 2nd, which by the way, we launched Feb 2nd post-close. Feb 3rd was the start of, that was SaaSpocalypse Day, where Anthropic came out with plugins for a bunch of different verticals and specific use cases, and the whole group derated. And we thought in our launch piece, we struck a pretty pragmatic view of, hey, here are the challenges for the space. We downgraded multiple names and we cut the price targets for basically every name in our list, as the peer group had derated significantly, and are concerned that, hey, even if the earnings group remains robust, we have to value these companies on a different terminal multiple than we did historically. Now, the optimistic case is that the names are getting pretty cheap from a variety of standpoints. You're approaching kind of mid-teens, even for cash flow ex SBC multiples for a lot of the highest quality names. And for many of them, they're either growing high single digits or low double digits. And so you can kind of get comfortable with the fact that certain names are still growing nicely, still have strong earnings power. And I think the bull case is these companies can both sell AI products externally and potentially increase ARPU. Again, we talked about how the headwind is that has not led to accelerating growth. And then part of the other bull case is that some of these software companies can use AI internally. For many of them, software engineering or the creation of software was one of their highest expenses. Engineers are particularly expensive, but if you can use tools like OpenAI Codex or Claude Code to make them more efficient, and there's this kind of this shift to labor from labor to tokens, they can be more efficient on their OpEx lines as well. And so ultimately, the goal is that maybe some of these companies become more profitable. There's been the shift in software where these companies are now maybe issuing debt for the first time or buying back a lot of stock or both. And so that's part of the bull case as well. Salesforce, for example, in the first quarter bought back 27 million in stock, which is great to see because for many of these companies, Salesforce is a good example. Tableau was an acquisition they did. That was an all stock-based deal. And then Slack, which was their largest deal, was a mix of cash and stock. So the shareholder was diluted over time, and now the capital is finally being returned. Now, the knock against Salesforce is going to be they bought back 27 billion in stock in the first quarter. And frankly, like the stock didn't go up. It's trading at a lower price than probably where the average of where they bought back shares. And I think that reflects where investors' sentiment was at. And I'll go back to what we talked about at the beginning of the convo, which is I think investors are picking their spots on where they want to do work right now if you're going to play in the software space. And that's either direct AI beneficiaries or companies already accelerating because of AI. And there's not many of those. I think our pitch, our view when we launched on Feb 2nd was where can you hide in this space? And we picked 3 spots. So one was the hyperscalers. So in our list, we cover Microsoft and Oracle, where those cloud rev lines are accelerating nicely at scale because we're in an environment where AI demand for compute vastly outstrips supply. Now, to be totally honest, that actually hasn't quite worked year to date because there's also the opposite concern that both those companies are spending a lot on capital expenditures to build these AI data centers and have taken free cash flow basically to zero, or in Oracle's case, negative, and they've taken on both debt and equity to fund that build out. The other recommendation was hide in kind of non-hyperscaler businesses that already charge on a consumption basis. Now, the best ones, unfortunately, I don't cover my list. They were covered by Rob Owens or Jim Fish. And you've seen some names like Datadog, Snowflake, or Twilio do very well year to date because they charge on a consumption basis. Is AI has led to more data or usage or volumes that's benefited these companies in kind of different ways. Again, all those companies are idiosyncratic, but those are flat to up for the year, which I can't say for most of my list. And then our final recommendation was to hide and call it select vertical software names. Key on select vertical is in the monolith. There's tons of vertical software companies that serve different end markets. We don't cover ed tech, but that's a space that is frankly particularly challenged by AI. One of the vertical names we do cover, which has consistently been our top pick for the year, and every month or when it changes, we stack rank our coverage list from favorite name to least favorite so clients can see where our heads are at. Our favorite name is Service Titan, which is ticker TTAN. They are a vertical software company for skilled laborers. So they do the best with HVAC technicians, plumbers, electricians. That's an end market that, at least right now, is not being disrupted by AI. If anything, it's one of the fastest growing parts of the economy. So with that company, I don't have to worry about seat growth, like what we talked about at the beginning in terms of the headwinds. And then as we think about vibe coding disruption risk and some of those concerns, it's an end market where in many cases, and again, there's different sizes of plumbing shops. There's the mom and pop shop around the corner. There's the large kind of private equity roll up. But in many cases, those end customers moved not that long ago from, call it pen and paper, or only accepting checks for payments and now accepting credit cards. And that's an end market where we think they just want software in a box that kind of works. And ServiceTitan's pitches, we're an end-to-end vendor. We do everything for the end customer except processing payroll and accounting. And we're everything else, the calling, tools, the dispatch, scheduling, inventory and procurement. It really combines 8 to 10 different software products. And so that's our top pick for the year. Now, the criticism, if you look at the chart, it's also down year to date. And part of the issue is, as investors have left software, the broader multiples for the group have derated. And that's been like gravity on even great companies like ServiceTitan, which we think has executed pretty well. We can talk more about the name. Our thesis is that they're rolling out their own AI monetization SKU to their customers. It's called Max. We've done a couple notes on it. We did one where we walked through what that ramp can look like. We also just hosted IR for meetings in 2 different cities across 2 days. I think we get comfortable with the fact that Surface Titan's rev growth could actually accelerate next year. There's a case where that could happen on AI, and we think investors are coming around to realize that. So that's a company where we've had a lot of our investor conversations on, especially those that can own names at the spin layer.
So it sounds like there's a tremendous amount of fundamental differentiation within the group, but certainly the group as a whole, in a way, has been almost used as a financing source on the short side of the momentum trade. We've had the whole momentum trade is you could just slap on a chart of semis to software and it looks pretty much the same. And so I think you saw a lot of hedge funds, or at least we've heard that over the last 6 months, year to date, where they were using small caps, IWM as a financing source to short things. And that was a popular short. And now it's moved over to software. And so I want to talk real quick on, you mentioned Oracle. I'm sure you're getting a ton of incoming questions there. As of today, the Friday, the 24th, the CDS of Oracle, the 5-year CDS, credit default swaps, so concern about their balance sheet is sitting at a new high at over 200 basis points. The stock has obviously had this big run up last year and has come all the way back down. Is that a canary in the coal mine? A lot of people keep talking about that stock specifically and the whole hyperscaler basket as a whole. We saw Alphabet report this week and beat CapEx expectations. The market punished them. We've gone clearly to too much of a good thing in terms of CapEx. Do you expect these companies to pivot in the future? And maybe, I don't know if there's anything specific about Oracle you want to see, because obviously as the market continues to pressure the equity and the credit, and it's not just unique to Oracle, what do you think is going to take for these companies to respond to the market?
A lot of good questions in there. I'll start again covering both Microsoft and Oracle. And it's been interesting to evaluate the space because I think there's a certain amount of investors who, I'll start with Microsoft and I promise I'll get to Oracle as well, who see the CapEx spending and then they see the cloud growth inflecting or accelerating. And some investors see that as a good thing. And if anything, they believe if the AI opportunity is as good as many think it potentially will be, these companies should be spending more and they should be leaning into the opportunity. And you've seen, call it the largest hyperscalers, a lot of people anchored to the big three, which is going to be Amazon, Microsoft, and Google in that order. They actually believe those companies, this is the probably best opportunity in their lifetime, and they should be spending as much as possible to capture it. And I think the companies are in a weird spot where if any of them tries to be a little more pragmatic about their spend, that's viewed as not leaning into the opportunity or potentially ceding share to the other vendors. Because we're in an environment right now where demand for compute, especially with AI, vastly exceeds supply. And anyone with kind of excess compute right now sets their own price in some cases. You can go back and look at the example of Anthropic signing that deal with SpaceX for Elon Musk's Colossus One data center. And you can also look at Meta, which for a while was building their own data centers and then announced that, hey, we're actually going to sell excess compute externally to other customers, and basically signaling that Meta could potentially become a hyperscaler as well. That actually feeds into where sentiment has shifted on Oracle, which I promise I'll get to. But so on Microsoft specifically, there's certain investors who they gave us $190 billion for the calendar year. And remember, next week, they're going to report their fiscal fourth quarter. They're a June year-end company. But for the calendar year, calendar 26, $190 billion in CapEx plus lease obligations. Now, for the first time, you can do the math and kind of how that will look. If you go to the calendar fourth quarter, so that's Microsoft's fiscal second quarter of 2027, free cash flow goes negative for them for kind of the first time. And I think the question from a lot of investors is, does Microsoft raise it for fiscal 2027? Do they come out with a number that's in the mid 200 billions? Is 250 billion is something I hear thrown out a lot by a lot of investors. And I think broadly the view, even in the last month, is that an Amazon or Google could end up saying that their CapEx number in 2027 could be 300 billion. I know Google this week on their earnings call said 2027 CapEx numbers will be up significantly. So everything's going in that direction. And there's a variety of reasons for that. The leaning into the opportunity, not being willing to cede share to competitors. There's also higher component prices. So you can look at memory prices year to date. The memory prices are even a lot higher than when Microsoft gave that 190 billion number last quarter for the calendar year. So now there's also a number of investors who look at these CapEx numbers and think this is staggering. And these large hyperscalers are in many cases either taking free cash flow close to zero or negative, and they're funding the difference with debt. And I think the kind of remarkable thing is Oracle was the first. They announced that they were going to do a 20 billion ATM in equity to fund the difference. Google announced, I believe, an 80 billion equity raise to help fund the difference and support this build out. So you're seeing both debt and equity utilized to build these AI data centers. And with Microsoft specifically, the key debate is 250 billion a good thing? Does that mean they're leaning into the opportunity and they have one of the best balance sheets of publicly traded companies, so they could take on more debt and fund the build out and grow Azure faster? I do think there's a lot of investors who think Microsoft to date has been much more pragmatic in their capital expenditure spend and don't want to see them do that. And that's a big debate amongst investors right now. And the ones who want to see them spend more, look at Microsoft's CapEx pause last summer, where they basically had a quarter where they said, why are we spending so much now? We're going to have all these data centers that are in the same family of NVIDIA GPUs that are going to be depreciated over the next few years. And we don't want to overly spend on kind of one single family of GPUs when an AI data center 2, 3, 4 years from now might actually look very different than it does today. And so we want to be pragmatic about the spend. And people have been giving them a hard time that in retrospect, they've either been adding fewer cloud rev dollars than like an Amazon or accelerating less than a Google. So that's a big debate right now. And Oracle specifically, Oracle is in the position, and I've covered Oracle a long time, where they were trying to be, call it like the fourth largest cloud vendor. And I don't think people would push back on me on this. They were a little late to the game in terms of OCI, in terms of scaling that business. Now, for a while when demand exceeded supply, Oracle was in, and you could argue they continue to be in a great position as kind of this next vendor. If demand exceeds supply and you're a cloud vendor with excess capacity, you can set price and do well in this market and build data centers profitably. And again, Oracle's argument is numbers kind of change here day to day, but there's vendors in Oracle's ecosystem who talk about how it's, call it 40 to 50 billion to build a gigawatt of compute, basically. And that there's obviously like depreciation costs around that, but like the annual, call it OpEx on that AI data center is pretty low. And there's some calculations that you could actually, it basically starts becoming profitable in about 3 years is kind of the calculation. I would highly recommend the CEO of Crusoe, which is a close partner of Oracle's and an infrastructure builder, had a speech a few months ago at Stanford, where he put numbers on kind of the upfront expenditures in the mix of both the kind of both GPUs, land, power. He put hard numbers behind the upfront investment, what it costs to run the data center over time, and the potential like revenue per gigawatt or megawatt you could generate from that. Oracle specifically, they did not have the balance sheet of the other hyperscalers when, like, post 2017 tax cuts under the Trump administration, Oracle was able to repatriate all its cash, and they bought back at the time like 20 to 30 billion in stock that fiscal year. And so they basically spent a lot of their excess cash flow on buybacks. And so as they've leaned into this AI opportunity, they've had to take on debt to do that. And Oracle stock, Michael, you were signaling it peaked back in September 2025 when they announced basically a deal with OpenAI that amounted to 300 billion in backlog, which is pretty phenomenal. It's an immense commitment from one of the leading AI players, and the stock ripped on that announcement. And then I think after that, there were a lot more questions of, hold on a sec, how much is Oracle going to have to spend to fulfill that backlog? Do they have the cash or balance sheet to do it? What's the ROI of that? And I think a big question for these guys is Oracle's been very clear that for OCI, for its largest OCI is their cloud business, which a lot of it is bare metal compute. That's another kind of criticism of Oracle, that they don't necessarily have a long list of kind of upsell products on their cloud business that like a Microsoft or Amazon have that are much higher gross margin and where you're actually making money. This could be a side conversation, but Amazon's made a lot of margin, kind of the ingress egress fees for their data center, where Oracle for a while, they did make arguments that it was actually like a cheaper solution. Now, Oracle would also argue that they have the most kind of performant software at the infrastructure layer, and that's their core advantage in the data center, but I'm getting sidetracked. So after OpenAI announced the deal, then the question was around funding, and part of it was gross margin. So Oracle said 30 to 40% gross margins on OCI. Now, the largest vendors like OpenAI will get 30% gross margins. Smaller vendors might, because they'll get the best price, and that kind of makes sense. They negotiate it down. Smaller customers, the gross margins like 40%. I think there's a lot of investors who question that and then question the ability of, hey, if component prices keep going up, does that pressure margins for, call it, longer term contracts? Oracle was very clear in the 4Q callback when I've talked to them. That is not the case. They're only going to do fixed price contracts when they have a sight line into fixed costs. If they've already purchased everything, the data center's online, they might do a 1-year deal at a set price. But for longer term contracts, including the OpenAI one, it's fixed price plus input costs, which allows them to protect, call it, the 30 to 40% gross margins. I think the bigger question for Oracle, and the stock's gone down for a variety of reasons. One is Meta selling excess compute, so potentially more competition, which might limit the ability for Oracle to keep margins at the same level or set higher prices. I think 2 would be just the balance sheet. They've taken on a lot of debt. Credit holders have dug in. S&P the other week downgraded the rating to just above junk status. So that kind of leads to concerns that they won't be able to issue more debt. And then 3, after 3Q or late last fiscal year, so their May year ends, Oracle just wrapped its fiscal 2026. They announced they're going to raise $20 billion in equity in basically an ATM, and they signal that it's like a buyback in reverse. They could be opportunistic when the stock price is high. They don't have to raise equity when the stock price is low. Now, ideally, they would have been able to raise money when the stock in May went from 200 to 250. Unfortunately, like most of that time, they're actually in quiet period, and they could not raise equity. They weren't able to raise that equity in quiet period. And now when they reported the fourth quarter, they announced that they're going to raise $40 billion in additional funding to fund the CapEx build out in their fiscal 2027, which they just started in total, inclusive of the $20 billion they already announced. Now it seems like the extra $20 billion also has to be equity. And I think the big question is there hasn't been a press release yet that they've raised, called that initial $20 billion. And so every day the stock goes down, it exacerbates the issue of, do they have enough cash on hand to fund the OCI build that was promised to deliver on these applications? And it could potentially lead to more dilution at a lower price. So it's become a chicken or the egg type thing. And unfortunately, the stock's fallen off a cliff since 250. I think our long-term view, we're overweight on the name. I know there's a lot of debates on this company. Is one, there's scarcity value in accelerating software companies right now. And bears would argue that Oracle is investing in OCI, which is gross margin dilutive business, and the ultimate profit structure of this company can look very different several years from now than today. Our view is, and I think this is going to be Oracle's focus at their investor day in October, is what is the cash flow payback period for these AI data centers? And we're still in an environment where demand exceeds supply, and there's limited companies to there's scarcity value in that there's limited companies to play the AI infrastructure build out. And if demand continues to exceed supply, again, they announced 8 billion plus RPO customers in the last quarter. There's not many options for who those could be. I've heard a lot of speculation that they could be Anthropic, XAI, or Meta. And so there's a diversification a little bit of the RPO balance. Now, they're still mostly tied to OpenAI, but that's come down since the OpenAI deal was announced. I also think Oracle kind of trades now with call it the neo clouds, like a Core or even Nebius, because they're doing this OCI build out. But you also have a longstanding ERP and database business, which, if we're stack ranking software from first to last in terms of switching costs and moats and durability, like I would put both those things near the top. And there's going to be debates around ERP, especially the mid-market ERP business, but NetSuite bookings accelerated exiting the last quarter. We think there could be upside in the apps numbers business in 2027. They bought a company called Cerner several years ago, which is healthcare electronic medical records. That's an incredibly sticky business that frankly wasn't growing quickly for a while because they probably underinvested in it. Now they've re-architected that whole tech stack on Oracle's cloud. That's going to return. And then they have a big government deal with the VA. So you layer all those things. They have a new CFO who it seems like is going to play the beat and raise game. And to name we have an overweight rating on. The question is more around timing of kind of that equity ATM. And every day the stock goes down, it exacerbates the issue.
All right, Billy, we're in the beginning of earnings season now, and most analysts have, like yourself, have most companies still ahead of us. Given the volatility and concerns in the stocks and what we're seeing in some of the hyperscaler credit default swaps, do you think we're going to hear anything of a surprise or material improvement in some of these concerns during earnings season? Or do you think companies are going to kind of take the longer term approach and just kind of continue to plow through and not react so much to what's taking place day to day in the markets?
Yeah, I think I would separate it in terms of call it the hyperscaler versus call it horizontal app software names. Again, we've only had 2 report this season. ServiceNow, who we're constructive on, we think reported great results. In SAP last night, we're neutral on for a few different reasons, largely that we think that their on-prem to cloud migration is going to take a little longer than people think. And they had flagged the previous quarter about their exposure to call it the Middle East and some call it macro challenges there that were impacting numbers. But SAP put up good numbers as well. And I would actually say in both results, you aren't seeing signs of the SaaS apocalypse really show up. As we look ahead, I think for Microsoft, we already talked a little bit about potential for a larger than expected CapEx number, either for calendar 2026 or as they guide, or they provide a forward look potentially on 2027, that it ends up being like a 250 billion potential number for fiscal 2027. That could be possible. And again, we had already talked about there's 2 camps of investors. And we're not totally sure how they'll react to it. I think most investors do want to see them lean into the opportunity. And then Microsoft also, we hosted management meetings intra-quarter. Big focus on, to be honest, a bigger focus on their apps business and Copilot specifically, rather than Azure and CapEx recently. Because the view is, we're worried about seat growth, as we talked about at the beginning of the call. Microsoft has the largest seat-based business out of any software company. And so Microsoft was viewed as an AI winner for a very long time. And I think many investors still can continue to see them as an AI winner because of the Azure side. And they obviously were tied up very closely. They still own 30% roughly of OpenAI, and they had that tight-knit partnership. And they rolled out Copilot, which seemed like it's one of the first tools from an existing enterprise software company to provide AI chat productivity for the end user. But the view now is that I think there's a lot of investors who are using Claude Cowork day to day, and they view that as a missed opportunity from Microsoft. Why isn't Microsoft owning this? Why can't Copilot help me in Excel as well as Claude Code or Claude for Excel or these different plugins that they have? And so that's become a broader question for the apps business. Microsoft is committed to they added 5 million Copilot seats last quarter, 20 million total. They've committed to more than 5 million ads this quarter. So I think there's going to be a big focus on what's more. Can they add 6, 7, or 8 million more quarter over quarter? And to be totally honest, we think Microsoft is making the right changes here. The optimistic view of Microsoft is that they've always been a fast follower. They were late to the cloud and they got that right. I think a lot of investors forget back in 2018, the view was Slack was this new enterprise operating system, and Microsoft was late, and Slack could be bad for both the Windows and productivity business. But Microsoft launched Teams. We were at Microsoft Build back in 2018, where we saw all the kind of integrations with Teams. And then obviously that business took off during COVID because of Microsoft's scale and ability to bundle different products together. And Microsoft, by the way, has a new bundle at the high end, which bundles Copilot, something called Agent 365, which is kind of this governance layer for if you're going to have enterprise agents in an organization. So we think they're making the right changes on the app side, but there's going to be immense focus on Copilot ads. I think broadly for the rest of the list, I think there's a couple companies where you saw them signal. Again, we talked about this environment for software where numbers haven't been disastrous, but anything that remotely signals weakness or lower beat magnitudes feeds into the AI disruption narrative.
Yeah.
For a lot of investors, even if companies aren't admitting it. So a company like HubSpot, which we're overweight on this past quarter, signaled that they're pivoting harder into AI products and shifting more of them to a consumption or outcome-based pricing model, which is something we haven't talked about yet, but is the right thing to do in this environment. The problem is they signaled that at the beginning of April, they retrained the sales force on some of these new products, so there was a lower start to the second quarter. They also signaled that they're going to introduce 28-day free trials, I believe, so that customers can use some of these AI products. And they've cut prices for the AI products, which I think some investors have criticized that is, hey, HubSpot was always a cheap way to play AI, and that was the bull case. Now their argument is we're cutting prices to incentivize usage, full stop. We want all our customers to utilize these products. And so they're trying to make the right moves. And we agree they are at the time. I think there's going to be scrutiny on that print around, did they see an inflection in AI products? Are their sales reps being as efficient post taking them off the street and retraining them on selling these new AI products relative to prior? And are customers opting to use those AI tools after that 28-day free trial? So that's an example of a company where you're seeing, I use that example because it's the most exaggerated, but companies are pivoting from seats to usage or consumption, which many of them have to right now. But that's one where they signaled that they're leaning in, but investors didn't like that after the first quarter print because it means results could maybe be a little choppier and signals that maybe the next couple quarters could be a little bit of a transition period relative to what they initially expected.
Billy, thank you so much. It's so interesting to hear the numbers and people that are so familiar with it, because for people that are a little more generalist focused, it's so easy to lump these trends in. So you've done an incredible job of demystifying something that is a very complex subject, talking about how their software companies and the enterprise space is so different. Some is sticky. Not all customers are the same. How these themes have evolved over the years from Slack to Teams, and the first mover advantage always isn't what we think it is. Michael and I are so grateful to get that detail from someone that really knows the space, as opposed to from us on the outside looking in. That being said, what may be next in this AI cycle? What is the next thing that people are going to be debating and are going to be the focus of investors, maybe the next 6, 12 months or more?
It's a great question. And by the way, thanks so much for having me on the podcast. I'm glad to be here. In terms of what's next, it's a great question. I think the big focus is, if we think about the next year, you're potentially going to have large frontier model vendors IPO. And Anthropic has talked about potentially IPOing this year. OpenAI reports have signaled that they'll probably IPO in 2027. Again, we don't really know. We've seen kind of different rumors and filing reports, but timing is TBD. But potentially, as we look over the next year to two, both those companies could be public, and we could be able to see under the hood a little bit what the financials actually look like. Because now everything is speculation on rev run rates and costs. And there have been reports of how potentially these companies measure revenue differently or run rates differently. And I think that's where investor attention is going to go. Because ultimately, both those companies, they're AI companies. They're building large language models, but it is software. And so it's going to have implications for every name I cover, every name Rob Owens covers, every name Jim Fish covers. And it's going to carry an immense amount of focus. And I think there's a certain amount of investors who believe that maybe when these companies go public, it could be a clearing event for the whole space. And that once we could actually see the financials and economics of those companies, it actually might be good for a company like ServiceNow, which is growing 20% plus a year with 30% plus free cash flow margins, which I would argue isn't getting a lot of respect in this environment, when we actually believe that there's businesses within ServiceNow that are clear AI beneficiaries. I would also say, I think there's a certain amount of investors who believe when those companies go public, they will suck up vast amounts of capital because you want to be exposed to growth in those businesses. And the view is both pre-IPO and potentially post-IPO, both OpenAI and Anthropic are incentivized to make a lot of noise. They're incentivized to have lots of press releases, verticalize their products, move up the stack. That's something we haven't really talked about yet, where there's been a lot of debates the last couple of weeks, and this is a whole nother can of worms that I won't get into, around open weight models. And we went through this crazy period of token maxing. And now it seems like on the other side of that, we're going through this period of token optimization where enterprises are saying, hey, maybe scoreboards aren't the best incentive structure for our employees to use as many tokens as possible. We should be maybe a little pragmatic about how we're spending on this. But there's a lot of questions about what growth rates look like on the other side of that, or if some of the spend goes towards open weight models and enterprises, both internally and externally, try to be more measured about how they're spending. But there are a lot of investors who believe the frontier models will only get better. The models are gonna be the worst today as they ever are. Models will get larger. And you even saw OpenAI with GPT-6 5.6 sold. Big focus on how it's 54% more token efficient than many other models. So that now there's a focus of like both performance and cost. Both companies now offer tiers of kind of models for different use cases. But I think there's a certain amount of investors who also believe, which frankly is negative for some of the names in my group, that those models will only get better and will actually be in this phenomenal period of a couple of years from now in terms of vibe coding, that any app you want, you will be able to ask Mythos or whatever the next iteration of OpenAI's product ends up being, and you could spin it up immediately. And that's going to be a big focus for our space over time. If that presents a threat to software, or if large enterprises say, hey, we just want something out of the box that works, that we know is secure and governed. And so we're going to continue purchasing from prepackaged software vendors, which frankly is our belief right now. But again, our view is if you're going to be invested in this market, pick your spots in software. And we talked about how ServiceTitan was our top pick, continues to be, and we think that's where most investors' heads are at. But the market is changing incredibly quickly. And to wrap up, I think the focus of the next year is going to be, does OpenAI and Anthropic's revenue continue going parabolic on all the things we talked about, or is that offset by now this era of token optimizations and potential model routing and then a shift in spend towards open weight models?
That's great. Thank you so much for joining us, Billy. Really interesting. And I agree. It seems like everything is changing so fast, whether it's the macro backdrop, what the Fed's going to do, what the sentiment on tech and AI is. So I am not certain about the future, but I'm certain that what we'll be thinking in 6 months will probably be a little bit different than what the world thinks today. We'll get you back on and see where things have gone. Thanks again.
Thanks so much for having me.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.